Hello and welcome to another Escala interview with the fund managers. My name is David Bruty and I'm an analyst in the Escala Chief Investment Office team. Today I am delighted to be joined by Crispin Murray, who is the head of equities at Pendal. Crispin, if he doesn't mind me saying, is a veteran of the industry and has managed one of, if not the largest, but also the most experienced equities team in the Australian market, and has done so since his appointment to the role 22 years ago. As a consequence, he has managed a portfolio successfully through numerous market cycles and through times such as the GFC, the pandemic, and more recently, the turmoil of an uncertain geopolitical, monetary, and fiscal policy environment. Hi, Crispin, and thank you for joining us today to discuss the current state of the Australian equity market.
Thanks, David. It's great to be here.
Crispin, maybe if we start with your thoughts on the macro backdrop and how our market has performed through this year, through, it must be said, this heightened period of macro noise, particularly around US trade policy and where we stand today.
Yeah, look, it's been a very uncertain macroeconomic environment. And if I just maybe quickly look at the US first, and a lot of the issues in the US have been self-imposed. So clearly tariffs flowing through now to consumers and impacting their spending power. But we've also had immigration policy, which has really crunched population growth, which directly impacts GDP. And then we've probably had monetary policy, which has been too tight, and now we're beginning to see that reflected in rates coming down again. So that's meant that growth in the US has sort of moved from a mid two type level to falling below 1% in the fourth quarter and potentially reaching zero. So that uncertainty clearly is something we need to be mindful of in Australia. There is a bit of a silver lining here, though, but when it comes to the US and we look forward, what we see is that businesses are still making money. They're still investing. They're not actually reducing workforces dramatically. So those are normally signs that we don't fall into recession. And then we are getting policy stimulus, both monetary and fiscal stimulus kicking in next year. So we believe the US can avoid a recession. And that's important for Australia because Australia has a lot of things going for it now. And I don't think it will be derailed by the US. Firstly, I think what we've seen in Australia is finally, after a number of years where we've had very sluggish growth, we've actually had negative GDP per capita. I think we're finally seeing the corner being turned, and there's a few drivers for that. I think the first one is that real incomes for consumers are improving again, and that's partly because real wages are on the rise. As inflation falls, we've seen tax cuts flowing through. We've had a wealth effect, and then we're now seeing the effect of falling interest rates. And so all of those things I think are supportive for the economy, and we very much saw some early signs of that with the anecdotes that we got out of corporate Australia in this reporting season. And I think those sorts of signs that particularly the consumer is just beginning to improve. Notably, CBA talked about age demographics and people below the age of 35 a year ago. They were cutting spending on discretionary items. They were reducing their savings. Both of those things in the last quarter have turned around. So that's a pretty good lead. I believe that we'll see a better Australian economy in the next year.
And the Australian market continued to make fairly steady gains through most of August, which is a critical time of year as it is the month that the majority of companies are reporting either their half year or full year results. How did you and your team assess the strength or otherwise of earnings in aggregate?
Yeah, it's at a headline level, the earnings revisions for the market through that August reporting season were probably a little bit worse than average. But when you actually sort of strip it back, what you'll see is there were a handful of sort of companies that had outsized effects. So a James Hardie, Woolworths, a CSL. And then if you look at across the broader part of the market, I think generally revisions were okay, and particularly for the domestically focused companies, which were seeing sort of the improving consumer environment. So we felt it was a reasonably constructive reporting season. I think the pockets of weakness were either self-imposed. So companies like Woolworths, CSL have had their own strategic issues. And then there was also a group of companies that are exposed to the US, companies like James Hardie, Reliance, Reese, Blue Scope, which were all sort of exposed to things like home building, industrial sort of demand. That has been weaker, and those companies saw pretty lackluster volume growth that was impacting on their earnings. So those were the areas of weakness, but outside of them, what we saw was a reasonably constructive story.
And interestingly, I think through reporting season, we typically do see volatility in individual share prices as results are announced and digested by investors. But something which I think many investors observed through August was that this level of volatility was much greater than usual. Often you do see this play out amongst smaller companies, but this time there was some quite significant swings in what should be fairly predictable large cap companies like the major supermarkets, CSL, Brambles, Amcor. What, in your opinion, is causing this increased level of volatility?
Yeah, look, as you kindly pointed out, David, I've been around for a long time, and even for me, this was a, surprisingly volatile reporting season, and you can sort of see that in just the numbers. So you can track, what proportion of stocks move 5% on the day of their result, either up or down. And that number was 45%. And really, if you go back over time, that number was probably in and around 30, 35 historically. So there is more volatility. It's a reflection of the nature of the market. It's become more short term. It's driven by flow. It's driven by quant funds. It's driven by hedge funds. And so as a result of that, the event becomes a market moving moment. And it leads to sort of a very high sort of beta when it comes to any earnings revisions. And it's actually a really important point when we talk to companies now. One of the key roles for the CEO, when you think about what they can do to add value to shareholders, one of the most important things now is their ability to explain what's happening in their business, explain what the opportunities are, what they're doing to deal with any challenges. Companies who do that well can end up trading at very high multiples, high 20s, 30s, as you can see with Brambles and Wesfarmers. Companies who are not doing that, who leave the market confused, leave the market feeling that they're not addressing issues, those stocks are getting discounted, and those stocks can fall, into sort of relatively low valuation. So you can have companies with a similar trajectory on earnings with a sort of 50% difference in their multiple. So it's a really important point for the company management to sort of address. We think some companies do it well, some companies do it badly, but it needs to be really focused on. So I think a lot of it is stemming from that. What we would also say is that that volatility ultimately is good for active fund managers because it means there's more mispricing. And when there's mispricing, it means that you're able to sort of step into stocks at very attractive valuations. And as long as you have portfolio construction that manages risk carefully and that you can be patient, you can take advantage of that volatility.
And given the market did push higher again through August, can we point towards more earnings being revised higher as the key driver there, or was it again more PE expansion, which I think has been perhaps a little bit more of a feature of our market in the last few years?
Yeah, look, if you look at the performance of the market since the last reporting season, I think the market's up sort of around 11%, and you can pretty much explain all of that from rating. So, we're getting low single digit overall EPS growth in Australia at the moment. Revisions have been slightly negative, not materially, but slightly negative. And then it's all about the re-rate. And the re-rate's a global phenomena. And it does beg the question, markets now which are pushing up to the very high end of their long-term ranges on valuation, is that a risk to investors? I think it is important consideration. We believe that that risk is not an imminent risk. We believe that when you have an environment where the economy is doing a bit better, interest rates are coming down, earnings are okay. I think the market can sort of hold in there at these levels, be driven by earnings rather than rating going forward. It means lower returns, but it is something we need to watch for, and there's less sort of a safety net now given that high rating.
And just going to your point, I think you made about some of the more international focused stocks that perhaps struggled through reporting season. How many of those were sort of more, as you call, self-inflicted wounds? How much was it perhaps more reflective of some of the broader macro challenges that some of these companies face, or is it a little bit of both?
Yeah, I think it is a bit of both. I think, if you take a Woolworths you can clearly see the relative performance with the coals. There's a sort of a sales gap there, which, maybe in the order of 2 or 3%. That's material when it comes to something as sort of stable as supermarket sales. And when you sort of dig down into it, yeah, it really does come down to execution. And these are very intangible things. I don't think there's a big pricing differential between those two supermarkets. I just think it's their ability to actually be good merchants and position the right products at the right prices. So execution is important. And I think that's part of what we focus in on when we sit down and meet the companies and sort of dissect how they're performing. But then there was also this sort of broader macro issue, which is US-centric companies having a tougher time than the domestic Australian companies. So I think that was a more thematic factor. And we think, that probably continues for another few months. But if I was to look forward 12 months, there are some opportunities, I think, in those offshore exposed stocks because, the nature of the market now being short term is that the market has almost given up on some of these names. And so it's important to keep those in mind as potential opportunities.
If we perhaps now look at a couple of individual stocks that have been in their headlines, and CSL is one which I would be interested to hear your thoughts on. For many years, I would say it was the most dependable large cap growth company on the ASX, but it certainly has tested the faith, I think, of more and more investors, particularly since I think the pandemic of a few years ago. What is your view on some of the mistakes that they've perhaps made? How much has it been from external factors outside of their control, and can the business be turned around?
Yeah, look, it's a really interesting situation because when you step back and just start with how the stock is being valued, it's now being valued at sort of 17 times earnings. It's a discount to the market. It's never done that before. It's trading below the valuation of a Westpac or a NAB or a Harvey Norman. So the market's really saying that there is something fundamentally broken with the company and the business. And it's either a great opportunity for investors or there has been a substantial change in the nature of that franchise. So when we sort of diagnose what the issues are, I think a lot of them are self-imposed. What we've seen is poor allocation of capital over the years. The V4 deal was overpaid. They haven't been very effective in allocating their R&D dollars. They were probably overspending on capital. I think they also probably allowed their business to become a little bit too bureaucratic, too top heavy, and that actually makes you slower moving. So all of those things I think have happened. They've had some external sort of issues as well with the threat of tariffs, still a little bit of an unknown. Also the sort of rise of the anti-vaccine sentiment, which has affected their Securus business. So it's really been a collection of challenges. And I think what's happened in this result, this has been a slow sort of deterioration over 5 years, as you say, but it sort of came to a head in the result. And I think it came to a head for a couple of reasons. The first one was that I think they've actually woken up that they need to do something. So they announced a restructuring of the business. They announced a demerger of Securus. They highlighted that they were reducing their spending in terms of percent of sales on R&D. And so people saw that. And instead of reading that as a positive signal that they're addressing issues, they saw it potentially as a sort of a desperate reaction by a company that is seeing broader challenges in its business. And that leads me to the second issue, which is sales were less in terms of growth than expected. And part of that was a contract loss, which was a large one and was a specific country, which there was a pricing issue. The company says it's a one-off, but the market looked at that sales deterioration, looked at the sort of reaction in terms of cost out and other things, and decided that there was something more broken with the business. Now, we don't believe that is the case. We actually think the company's taken the first steps in restoring itself to being a much more respected and valued company. We don't think there's any major issues with the growth of their plasma business. We've got other competitors we can see. We still see that as growing high single digit. So we don't see that the business is broken in that regard. But they do need to do a few things. They do need to execute on making sure they keep share. They do need to ensure that they are a more efficient business, both in R&D and in terms of their overall administration. And they do need to ensure that they allocate capital better going forward. And if they do that, they actually have incredibly strong free cash flow generating capacity. So we think we are sort of at that darkest point in this sort of life cycle of this company. I think the reaction to the share price, to the result, is sort of triggering a much greater intensity of focus from the company. And ultimately, we think that will be a good thing. We've seen this before with companies like Qantas, like Xero, like Telstra. So we believe this could be an interesting opportunity on a 3-year view.
And on the other side of the coin has been Qantas,
Mm.
a company which you have backed in, including just a couple of short years ago when they were really making the headlines for all the wrong reasons. But since then, the turnaround has been quite significant, and the stock has been a really good contributor to the performance of your portfolio. What has been behind this turnaround? Has there been a structural improvement in the company and the domestic competitive landscape that you can point to? And what does the outlook look like going forward? Is the good news now reflected in the price?
Yeah, look, Qantas is a good example of how markets work. And if we dial back 2 years, it seems sort of not that long ago when we're in the sort of darkest days of that business with understandable question marks given the poor customer outcomes in terms of on-time performance, cancellations, issues with their workforce. But what markets do is they tend to just assume that there's nothing ever going to change in a company. And this is the great thing about investing in equities, because if things aren't working, something normally changes, change of management, change of strategy. And if you've got a good business structure, good franchise, you can turn that around. And that's what we've seen at Qantas. They addressed those specific issues. And I think it was important that it was very clear what they needed to do. And they were able to begin to improve their customer experience. They spent a bit of money. Market was fine with that. Shareholders actually want customers to get a good experience, and they're happy for that to be something companies investing because that drives rating. And then what we have seen is that we do have a good industry structure in the Australian airline industry. We've seen consolidation. It is very tough if you're not a scale player. Virgin now is a listed company with a very clear focus on returns, but they're also both quite responsible companies. And what you saw in this result from both companies is that they are adding capacity, about 5% next year, and that's because demand is strong. And what they don't want is to see demand drive too much pricing. They just would rather see benefit kicking in through higher actual volumes. And so I think it's sort of a sensible approach. The company is actually able to generate a lot of free cash flow, which is allowing it to invest in fleet. It's going through a huge fleet upgrade cycle, so it needs to be focused on returns to fund that. And at the same time, they're able still to pay a reasonable dividend to shareholders. So they're managing all their stakeholders well. I think the market is still only valuing the stock at under 10 times. I think really, if you look at the top 100, the next cheapest stock outside of the resource sector would be a BlueScope Steel, which is around 12 times. So we feel that given the consumer's actually looking in good shape and the industry structure's, stable, that there is still a re-rating opportunity for Qantas, given how much of a discount it is still to its history and to other similar companies.
Recently, the thematic of the growth in artificial intelligence has been a significant driver of earnings and equity prices in overseas markets, particularly the US. It would appear that the direct exposure here in the Australian market is a little bit more limited, but do you have examples of stocks that are tied into the theme? And as a follow-on, we are beginning to see more and more companies start to talk about the benefits and savings that can be realized from utilizing AI. So have you observed many examples, particularly from August reporting season, of tangible benefits or targets from artificial intelligence? Who are the potential winners here in the Australian market?
Yeah, look, I think there's maybe three categories that we can sort of reflect on for Australia. There's the sort of directly exposed companies. These are the data center companies, and this is an area that we have liked. We like both Goodman Group and NextDC. Next had a good outcome at their result. It wasn't necessarily this year's numbers, but they updated the market on their growth outlook, and I think people were surprised by how quickly the profits grow through to 27, and so the stock reacted well to that. And what we've seen, and we've had an analyst in the US at a tech conference recently, and they sort of feedback was that if anything, the demand for compute, which drives that data center outlook is, if anything, beginning to pick up. We're seeing a substantial scaling of franchises like OpenAI with their ChatGPT and Claude and Grok. All of these sorts of businesses where people subscribe to a monthly service, they're all growing very dramatically. We're seeing a lot more search happening through AI, the sort of what's called inferencing, where there's a sort of this iterative process where AI response is sort of cross-checking the sort of common sense element of their response. All of this is driving more and more compute. So what we believe is that the outlook is constructive, and Australia in particular is an attractive market because we represent a market where we've got good security. Anyway, we're part of the Five Eyes. We've got land availability, we've got access to renewable energy, we've got capability, we've got good infrastructure in terms of cable connections to other parts of the world. So Australia in itself can actually be a bit of a hub for the growth of AI globally. So we see that as an attractive proposition and why we still like those stocks. The second category is stocks that could be impacted in terms of their franchise by AI. And so software companies are in that category. And there has been some concern that maybe AI allows people to circumvent software and actually start doing it themselves. So there's been some question marks over that. We think it's a very nuanced debate. But what we see is that there is actually some opportunity for some of these software companies, and we would call out a Xero, which is a platform company. And so if you're a small business, you're unlikely to sort of start delving deeply into building AI capability. But if you're using a platform service like the Xero platform, and they can start offering you tools that take your data and use it carefully and give you advice about how you can manage your cash flows better, how you can sort of organize yourself in a more effective way. That is something that will add value to clients and they can, charge for that. Seek is another one that could fall into that category. So that's the second group that I would call out. And then the final group is the sort of the broader market and how and which companies can leverage AI, when can they leverage it, how much will it cost versus how much will it create opportunity for cost out or better execution. I think this is a slower burn. I think what we're hearing from companies, CBA has made some comments about this, a number of other companies did as well, is it does take a fair bit of investment. And the essence of AI is that it's effectively allowing you to start utilizing unstructured data in a far more systematic way. But the issue is, how is that data stored? How is that information captured in an organization? If it's not captured in the right way, you aren't necessarily able to take advantage of it. So there needs to be a fair bit of work in terms of the plumbing inside of a company to enable you to really leverage that AI capability. So I think it's a period of investment, maybe a little bit of frustration that it doesn't lead to many benefits in the near term, but it's almost a hygiene requirement for companies now that if they don't do it, other companies will. Those companies will start providing better customer service and you're left behind, and that becomes a bigger competitive threat. So I think they will spend the money, but will not necessarily see huge benefits in the near term.
If we just look at the broader large cap index here in Australia, I think a key concern for many investors, particularly in the last couple of years, has just been the narrowness of the market's returns. And by that, I mean it has been a select group of large cap stocks that have really been driving a significant part of the market's overall performance. The major banks are an obvious one to call out here, but there's others such as Wesfarmers, which have been quite important. Do you have a view on this and how it might be creating opportunities for active managers like yourself?
Yeah, look, I think this is a feature of the market in the last few years. We sort of refer to it as a sort of the narrative flow-driven market. So, gone are the days where people think too much about cash flows and sort of core earnings and valuation and really the story and the impact of flows is sort of the predominant driver of share prices in the sort of shorter and increasingly medium term. Ultimately, though, we think that will resolve itself. The history is that fundamental value always wins out when it comes to share prices. And, if we look at, say, the banks, a good example, the banks if you take the last 10 years, they've had no EPS growth effectively on average. And the banks have moved from a PE of probably around 14 times to 21, 22 times on average. So, that has driven the returns in the banks, but it's hard to see, given earnings growth going forward is going to be low single digit, it's hard to see that sort of re-rate happening again. To get the same equivalent re-rate, you would need the rating of the banks to go to 32, 33 times. I just don't see that happening, to be frank. So I think there are pockets of the market which are going to lag overall, and there is a lot of stock-specific opportunity that will play out. But the most important point here is it's not going to be everything else. Like there's still going to be a lot of businesses that face their challenges, have got complicated issues to resolve, and those sorts of companies we think will continue to lag, will still sit at low valuations. But the ones that can be successful, like we were talking about Qantas before, those sorts of companies, they can perform extremely well. And that's where we're sort of targeting our time and attention.
And lastly, I just wanted to touch on the outlook for the year ahead. We've now had 3 financial years in a row of declining earnings for the market, a large part, of course, which has been driven by normalisation in some key commodity prices. But does the outlook for earnings in the next 12 months look better? And secondly, after this period whereby the market has really been driven by an uplift in valuations as opposed to earnings, is it now time for earnings to take the lead?
Yeah, we believe that is the case. We think that there is a limit to the rating increase. I mean, ratings in the near term can always squeeze higher, particularly if flows are strong. But history is something that's normally a pretty good guide, and history would suggest there's very limited upside from that rating perspective on a sustainable basis. The good news is that we think earnings can improve from where they've been. I mean, there has been a big headwind from resources, and so we think back to the last year as an example. I think resource earnings have been down sort of 14, 15%. So that's been a big headwind. Industrials themselves have been able to sort of grow earnings. Looking forward, the market's expecting flat resource earnings. We think there may be a bit of upside there. We think there's sort of a little bit more resilience in commodity prices, and you are seeing stimulus around the world, which generally can be a helpful sort of tailwind for commodity prices. The banks, I think, will have lackluster earnings growth. We would probably sort of see it 1 to 4 as a sort of range. But the rest of the industrials, we think, can sort of provide mid to high single digit earnings growth. So overall, we think it wouldn't be, unreasonable to think a mid single digit growth rate in earnings, which may be what we get as a return for the market overall. But the upside is that, there's a lot of variance within the market and an opportunity to add value within that.
Thanks, Crispin. On that note, we might leave it there today. Thank you for your insights and time, and we hope to see you again soon.
No, appreciate your time, David, and your support. So thanks everyone for tuning in.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. Escala Partners is a corporate authorized representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.